So welcome to part 6A summary. We're going to talk firstly about bracketing and trending. We went through a couple of very nice examples. I showed you what we mean by bracketing and trending and how we move between bracketing and trending. So the first thing we're going to go through is, what were the three types of ways or methods in which a market can move from bracketing to trending. And the first one we spoke about was a loss of momentum. And what we spoke about here was where the market effectively just runs out of steam. So a graphic depiction, the market's moving sideways, we then start to break out, we distribute higher, distribute higher, and the market just runs out of momentum and starts to turn back over before then bracketing again. So effectively that was the first type of example we spoke about. We then had our second example, which is the excess, or where the market is initiative and runs into some strong type of responsive type price action. And that we called effectively a V, or an inverse V type pattern. This looked like on the chart where we would have a distribution, a little bit of bracketing, we would then have an extension, and a very quick reversal. Equally, we could have it to the downside where we continue and have a relatively quick reversal. That was our excess type example. And then we moved on and we spoke about the most aggressive, which is also a form of excess, but it includes volume, volatility, and a very excessive price. So that was the major difference between excess and the major excess. Now, the key that we identified with major excess example is that these tend to act as very good high and low swing points for some period of time. So when you see these excess tops made on volume, volatility, and excess prices, they tend to hold for some time. And a good example to look at is particularly the gold when we shot above the the 1900 level, as well as the oil when it was trading around the $140 a barrel. So those are the two very strong examples you want to look at for excess type highs and lows in the market. We then moved on and we discussed the idea of volume and volatility. And there were some very key points to look at in terms of volume and volatility. The key takeaway is, remember, volume is a relative tool. It allows us to measure the manner in which trade is being facilitated. High volume is very indicative of a lot of new business coming into the marketplace at various prices, whereas low volume is far more indicative of less sort of new business and maybe a lot more sort of passive type trade. So it's a wonderful relative tool, and we went through a lot of key understandings of why we use volume in developing our various strategies, as well as obviously volatility. Remember, volatility does not necessarily imply liquidity. Volatility does not necessarily imply more volume. Volatility just implies the market moving over a much bigger variance around the mean. So we distribute ourselves in a bigger type range than usual. Now, let's discuss a unique trade strategy that you can utilize and develop over time. Now, the strategy I'm going to show you is when we have a high volume breakout. So what this example would look like, and I'm going to combine it with a bracketing and trending example, is let's say, for instance, the market or the day has been distributing for some time. So the market is distributing, we're sitting inside the day's range, and we're auctioning up, and we're auctioning down, and we're auctioning up. We then take out a key area or a key reference point in the market, which is the high of the distribution. Now, if we see a very large pickup in volume, so let's say on average over the course of the day we've been seeing lots of little volume bars, and all of a sudden we see almost 3 times or 4 times the volume being traded over a period of a session on the break of this key reference point. That volume is a key identifier of new business that has come into the market. Now, when that new business comes into the market, firstly, we do not, rule number 1, no fading. So we do not want to employ strategies that suggest we go against volume. So straight away, if you can employ a rule of thumb rule into your trading, which is to not go against high volume moves up or down, you're already going to, sort of avoid a lot of pitfalls that a lot of traders make. So that's the step one. When you see that high volume, that relatively high volume, we don't want to go against it. Most important, we actually want to employ momentum type strategy. So we're looking for a continuation type pattern, and ideally we want to see quite a continuation of initiative. Again, how do we measure initiative and strength? Well, the depth in the pullbacks. Can the market pull back? Are there responsive sellers actually stepping into sell it, or are they merely just short-term sellers providing liquidity? So that would be our unique key strategy when we break out of a bracket or a market that's been bracketing for maybe a few auctions or maybe even a few days. The key is we want to see volume and, note, volatility on the break above on that trigger point. So that's our key unique trade strategy that we're going to deal with in part 6A. Go and complete the rest of part 6, and we'll see you again for the Blackboard series in part 6B.